Well, it's official. The Bureau of Labor Statistics is canceling the October release of jobs data and delaying the November release of data until after the next Federal Reserve meeting. You would think that the Bureau of Labor Statistics, if they're going to skip an entire month of data, would at least try to hurry up the November data so they could give the Federal Reserve something. But no, as a result, markets are not very happy, now predicting only a 28% chance that we'll get a cut in February, which in my opinion increases the risk of a substantial policy mistake from the Federal Reserve. It doesn't help that Goldman Sachs is suggesting we would have had a negative 50,000 payrolls read if they actually released the October jobs data. That is a problem. You can see that right here. We estimate that the unemployment rate was unchanged. That's the rate on a rounded basis. However, looking ahead, we expect the October non-farm payrolls, this was written before they canceled it, to show negative 50,000. Now, of course, markets would have then added back in the federal government's job losses because a lot of these job losses would have were expected to show up in September and October because of the DOGE cuts in February. But the problem is the federal government has been one of the last legs that has been hiring. So a lot of people would have looked at, okay, well, even aside from that, how good would the jobs data have been? And unfortunately now with the ADP trackers and Challenger job reports suggesting that planned layoff increases are accelerating, and we're not getting the jobs data that would have been pretty ugly, you can't help but think, especially after Donald Trump fired the head of the Bureau of Labor Statistics for, politically motivated data, you can't help but think it's oddly convenient that Donald Trump and his new BLS head are just going to happen to cancel what would have likely been the worst jobs report of the year, October jobs data. Now, of course, they can conveniently just blame that on Democrats, even though Republicans totally dug in their heels, which they usually don't do. And then as soon as October passed and we were getting ready to get towards Thanksgiving, we happen to start making Democrats some promises, convincing, a group of 8 Democrats to essentially extend the government funding, some parts of the government all year, some parts through the end of January. And so all of a sudden, you happen to get exactly what Donald Trump wants. Monkey see no evil. Nobody's going to tell me my jobs data is bad. Now, you might be thinking, but wait a minute, Donald Trump would want the Fed to cut. True. But Donald Trump also doesn't want egg on his face with a giant negative jobs report, and he doesn't want the self-fulfilling potential prophecy of what happens when companies start realizing, must be okay to fire. Because as soon as that cycle starts, it doesn't end quickly. Now, of course, right now, artificial intelligence is propping everything up. I mean, we've got Michael Burry posting, another piece on X. Michael Burry's recent X post is this letter from 1999 where there's this discussion about how Buffett should buy Apple stock, which was very early for its time. But in it is really this argument that you really should, this is from Michael Burry, mind you, you shouldn't just follow the crowd and buy things because they're popular, because there's a limit to how much you could pay for a stock. And you should be aware of those limits. I mean, this morning, for example, we were looking, this was one of the fundamental analyses we were doing on the course member live stream this morning. We're like, this is terrible, for Super Microcomputer, along with looking at margins and otherwise. We were looking at Fastly and Target and otherwise. But I mean, and cat's out of the bag now. Usually I just keep this stuff for the alpha report. This is the kind of stuff we do fundamentally plus technical basis. We got a coupon code expiring, by the way, for the alpha report, meetkevin.com. Get your tax write-off, likely tax write-off. But anyway, we're like, wow, look at this. Listen, just let me read this to you because it kind of leans into what Michael Burry is saying a little bit. The $919.5 million revenue, or 15.5% decrease in net sales, was primarily due to the timing of several substantial orders that were only received in late September. So in other words, which they weren't able to ship in time. If they didn't get those September orders, SMCI would have had an even worse report. Like, their pricing power is shrinking, their revenues are shrinking, and it's weird because you hear this boom because of, Gemini, but it makes you wonder, is that boom going to continue to be broad-based? And this is something we were questioning as well this morning. When we look over here, we could see Gemini 3's performance. And you can really go in two directions here. One, companies fail and go bankrupt thanks to Google, or two, companies lash out and want to spend more. Obviously, the bullish theory is that companies lash out and want to spend more, but it also just increases the risk that you need more deficit financing, debt spending, to actually get xAI and OpenAI, profitable and actually get them to be competitive, because right now Google is destroying them. And they're going to have to take on even more debt. And it's scary at a time where, really gay things are happening. I mean, Grindr, you've got a stock crash that's happening at Grindr, which is trading for a 1.25 peg, because literally the owners of the company that own 60% of the company pledged all of their Grindr shares to take out personal loans. And all of a sudden they're getting margin called and they're getting their stock seized and they're getting liquidated because they're margining against their own company stocks to go spend personal money. I hate to say it, but that's also what Elon Musk is doing with Tesla shares. He's pledging Tesla shares to raise cash to try to pump Tesla stock by buying some. So you borrow against Tesla stock to go buy $1 billion of Tesla stock to try to pump the stock, to pump up the Tesla shareholder base, to get them to approve your stock comp plan so you can borrow more, so you could take that money and go invest it in xAI so you could prop up this bet against Google, and you're borrowing even more. It's scary. It's a lot of debt. It's a lot of debt. I mean, we were looking that the Grindr folks are literally going for bailout financing from a company called Fortress. And it took me a minute to remember where the Fortress Group came in. But the Fortress Group came in 2022 to provide a bailout credit agreement to Red Robin. The burger joint? Red Robin. Yum. Well, guess what? When Fortress comes in, it's usually a bad sign that we're not ready for what's coming.
You are not prepared.
And it makes me nervous because, again, we're seeing more and more debt spending for likely what are probably going to be these commoditized products. At the same time, the jobs data is bad. I mean, 67% of you in my live stream refuse to pay for chatbots. And honestly, the base level chatbots are getting pretty damn good. And so now here we go. The BLS is rug pulling us on the October jobs data, saying they'll give it to us in November. But then that November data, they're going to delay until after the Fed meeting. So we're literally delaying jobs data another month. So we're going to get good September data. This has Trump engineering written all over it. Give us good September data and then go dark on the markets for a month so we could try to pretend that everything is fine. But people are seeing through this. And what's happening is they're starting to hedge. I think it was in this article where we had, where they were saying institutions are basically starting to hedge against this. So, mind you, I want to just finish the point really quickly and then we'll look at that hedging article. The BLS will not publish the October employment situation. Somebody in the comments is like, oh, but Kevin, how could they? They didn't collect the data. Two forms of data. The payrolls data, these are job surveys that they keep coming in. It's like envelopes that show up or electronic surveys, they show up. Okay, that still comes in. But them picking up the phone and calling, that data doesn't get collected. So I understand that. But you could release half of the report. You could release the data you have. But they're not even doing that. They're just going to kick the can down the road until after the next Fed meeting. And so now you're at less than a third of a chance that you're actually going to get a Fed rate cut in December, which just increases the chance of the Fed making a policy mistake. Because you've got labor deteriorating, falling off a cliff. Donald Trump is hiding the truth of that data while at the same time demanding rate cuts. While at the same time, he's demanding rate cuts while the Atlanta Fed GDP is skyrocketing. We're at 4.2% now. Now, how do you put all this together? Because it seems like that's good news that GDP is going up, right? But GDP is going up in part because trade is plummeting. Imports are plummeting. Look, Trump global tariffs curtailed trade, data shows. Imports of goods and services dropped 5.1% in August. This data comes out very slowly, blah, blah, blah. The problem with that is when imports fall, they artificially make GDP look high. So I think the greatest irony will be that we will end up having this really high GDP report because tariffs are falling or imports are falling. So you're artificially propping up GDP with AI spend and with a lack of imports. And the greatest rug pull is going to be us actually going into a recession. And then people are going to go, but Atlanta Fed said we were like 4% positive GDP. oh, well, that's only because of the data abnormality of us having to, basically add back in the fact that we were importing less. So that just artificially propped up GDP along with artificial intelligence spend. Well, that's not great. That's a bunch of fugazi. So everybody's taking on more debt. The grinder folks are going bankrupt. The Wall Street Journal is warning that a private credit winter is coming. And they say that the leading indicator for this is lenders shifting their focus on what they call real-time covenant changes. They say, quote, there is no better leading indicator of market psychology than real-time covenant changes, which is basically smart money fortifying against a downturn. There's the line I was looking for. So smart money is fortifying against a downturn. We see this crap brewing. We run a fundamental analysis daily in our alpha report, and we're looking at what's actually fundamentally happening at Target, for example, and some of these companies that are like, everything's fine. We're going to remodel our stores. And then you go look at their balance sheet and their cash flow statements, and you're like, with what money? It's fugazi. Until these companies keep taking on more debt, they don't have money to pay for this. It's the same at Target, and it's the same at the artificial intelligence companies. The problem is, and we don't have to rehash this, but the reality is these private lending vehicles are such a scary disaster that you literally see that Blue Owl, who was just basically trying to scam their shareholders, that's my opinion, okay? Blue Owl got pretty much exposed for their scam, and now they're calling off the merger. So let me just briefly try to explain what's happening here, and I'm going to give you the basic explanation because, in fairness, I don't fully understand it either because it's so convoluted, and I do finance on a daily basis. But here's basically what's happening. Okay, there's a Fund 1 and a Fund 2 of this Owl company, this Blue Owl right here, okay? Their company has lost like 40% in market value already, so they're already scrambling because they're like, dude, our stock's plummeting. And what's happening is they have these little feeder funds that are selling for less than book value. They're selling for a 23% discount. So the way you have to look at this is like this. This is what's happening at Owl. You have people are freaking out. Okay, so that's the foregone conclusion number one. One, smart money is fortifying and getting out of these private credit plays. Private credit winter is coming with, a strengthening in loan covenants, right? We know that, okay? Owl Fund 1 is public, okay? Then you have Owl Fund 2 that's not public, okay? This one has the right to redeem shares at 100% value, NAV. This one trades at public value, which is a negative 23% discount to NAV. So investors here are losing 23% and they're dumping more. So that's why, so investors here are like, yo, let's quickly get out here of here before we can't anymore, okay? Then Owl says, no, let's stop withdrawals. I kid you not. Let's stop withdrawals and come up with a better idea. We'll redo withdrawals in January, okay? So that way they can come up with a better scam. The problem is, so far, their first attempt at a better scam is failing. Calls off merger between two private credit funds after announcement rattles stock. Yeah, no kidding. The firm planned to merge its smaller non-traded Blue Owl Capital Corp into the larger public traded entity, even as the merger would have meant 20% losses, right? So they're trying to stop the bleeding, but the bleeding's so bad that the market's basically no, like, hell no, F you. We don't want you to put a bandage on this. That's my opinion. Don't sue me, Blue Owl, okay? It's not my fault. You have
Little PP.
It's not my fault. We're just looking at what's actually happening, and I have a feeling that if Donald Trump looked at what y'all were doing right now, he would have a few choice words for you.
They don't know what the fuck they're doing.
Yeah, exactly. So this is weird. When you put all of this together, it's just weird. Now, maybe this will all blow over. You know, maybe we'll find some new catalyst to go buy Bitcoin. Like The Economist is like, crypto got everything it wanted. Now it's sinking. Yeah, because there's no like next level catalyst is what The Economist is arguing. Like everybody's already in, right? Okay, so now you have a Fugazi propped up GDP. You have monkey see no evil on the jobs report, where we're literally getting rugged on even partial data. We're not going to report the data until after the Fed meeting, which now reduces the chance of a rate cut in December, which means we have even more of a chance of a policy mistake. The Federal Reserve's blackout window ends on Black Friday. So next Friday, or sorry, it starts on next Friday. Next Friday, the Fed's going to go, no more talking from the Fed. So the Fed has a week and 2 days left, or 1 day left, to try to convince markets actually to price in a rate cut. But they don't have the data to do that. They're also rug pulling the JOLTS report for September, because these are always 2 months behind. So we're not going to get the JOLTS report that was due on November 4th. And we will get the JOLTS report for October on December 2nd. Sorry, December 9th, which will be the day before the meeting. But we're not going to get any jobs report other than September, which should be the one good one, before the Fed meeting. Yet somehow Donald Trump wants the Fed to cut. Now, again, I get it, because Donald Trump doesn't want the market to sell off. So he has to call for cuts and hide bad data. It's a little dictatorish. I hate to say it. I thought he was only going to be a dictator on day one. I didn't vote for Trump. Remember, I voted for myself. That's what I said I was going to do, at least. Did I vote for myself? Did I write in Meet Kevin? The only guarantee I'll make you, I'll clarify that. The only guarantee I'll make is I didn't vote for Trump. And I did publicly say I might write in Meet Kevin. I can't run for president anyway. But anyway, it doesn't matter who I voted for. It really doesn't matter. I'm 51-49. You know that. So then you have Zero Hedge here complaining about a short-term flip in momentum signals, which is bad. CTA selling in every scenario. I generally think you do the opposite of what the CTAs do, but you know, whatever. But look at this. They also make this very interesting argument. They go, why is it that since October, gold is down, treasury bonds are down, stocks are down, and Bitcoin is down? Everything is going down. Why are they going down? Well, Deutsche Bank thinks everything is going down because the Fed is going hawkish. But the Fed can't go not hawkish. Why can't the Fed not go hawkish? Or why can't the Fed go dovish? Because they don't have the data. They don't have data.
Data dependent.
But there's no data. The only thing there is
Coupon code expiring soon. Coupon linked below.
It's because that's why.
Yeah. So these pressures are likely to persist given that inflation is lingering above target. Right. It's not great. Historically unusual rally as well. And a lot of debt. The debt situation is crazy. It's absolutely crazy. So I don't know. This is all wild and not great to me. Now, what I also think is wild, but I think is great, is that a wedge deal that we just bought with HouseHack, our AI finder gave it an A score of, and we're kind of like, this is great. We're like reconciling that literally where we're putting our money is aligning with our AI finder. So I personally am pissed because I don't want there to be, you know, some market correction. I want this crap to keep mooning because I want to license the crap out of our AI finder. This is just like a background demo of the picture. But like this will be cleaned up a lot in our actual app. But we score properties based on how good of a deal we think they are for your net worth. And so this was an A score, and it's actually a property we bought. And it's great because it sort of reconciles with like, hey, this is like our AI is working, right? And so we can't wait to license this soon. If you want to learn more about that, remember to go to reinvest.co or househack.com. It's the same company. You get 5% yield through conversion and 100% of the upside of the stock. Read the offering circular. There are risks with every investment, but you know, we're a real estate backed play with the artificial intelligence upside. Now, in fairness, we're also prepared if there's a recession. I was talking about this earlier. I wrote, this is my Kevin's evil recession playbook. If there's a recession, we take the $80 million of real estate and cash, and we leverage that to the, well, don't worry about what I wrote there. We leverage that up, which turns into a potential $266 million book, 186 mil of loans at low interest rates, which we could then deploy into wedges, which we think we could turn into $40 million of gains for the company. Obviously, no guarantees. It takes time to do all that, right? That would put us at a 60% equity or a debt to equity ratio, which is actually pretty reasonable if you do that at like the bottom of a recession. We are like so excited about what we can do here. Like we think we have a giant piggy bank. That's the evil recession plan, but I'd rather no recession. So just being transparent about that. But the numbers are not great. You know, Bitcoin, we got another chance to buy under 90,000. I don't own any Bitcoin. And yeah, you know, so I see some people in the chat, Kevin, why didn't you vote for Trump? Oh, look at the 595 line. Alpha report, baby. I saw enough of Trump 1 that, you know, while I knew there would be some short-term enthusiasm for business, I generally don't want to throw my hat on politics, so I'd rather vote for Meet Kevin. But I think some of the short-term ploys for business just break what we have in our capitalistic markets and just sort of accelerate the bad. And I'm not a fan of tariffs. You know that. So economically, I think you create a short-term bubble that ends up hurting more people. But it doesn't matter who I voted for. Like I say, you know, I said I was going to write in Meet Kevin. So it doesn't matter. But anyway, the point of all of this is just, I'm very frustrated because I wanted at least some data, right? I wanted at least some data, right? That's usually what I see, like Ellis says, better than the alternative. I don't blame anybody for voting for Trump because I understand that sentiment. You know, there are a lot of people who are like, but Kevin, like, the alternative. I hate that. Like, that's why I'm like, I'm just gonna write to Meet Kevin, because it's like, why can't we have like a good choice? You know? I don't know. It did feel like choosing between two evils. It is what it is, I guess. But anyway, somebody's like, why don't you run for office again? Because I think politics is rigged. I think it's rigged and I think it's a scam. So I'm just going to shit on everybody. I shit on Biden. I shit on Trump. I shit on Kamala, Pelosi's, Newsom. I dump on them all. Okay? Maybe we can like gracefully unite against the politicians. But anyway, I'm pissed. No data, which means no setup for a rate cut in December, which is bad for yields, which is bad for the market because the market gets no data, so you actually increase uncertainty for longer. It sucks. Yields are flat on the day. It sucks. Anyway, that's what's going on right now. And the good news is you can still take advantage of the Meet Kevin report. You get the Meet Kevin report by going to meetkevin.com. Not only can you get the coupon code and guaranteed best price, but you might be able to get a tax write-off as well. Get all the trade alerts, all the courses, every private live stream, the alpha reports. Your membership includes it all. And meetkevin.com.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber Meet Kevin. Always great to get your take.